Hi folks, welcome back to our video where we're now going to look at preparing a calculation of consolidated net income so that before we do our actual consolidated income statement, we have a check figure. So let's begin. We know that the consolidation process is additive, meaning that when we're calculating the consolidated amount for sales revenue in the consolidated income statement, we take the sales of the parent and add it to those of the sub. Similar thing happens here when we're calculating consolidated net income. We start with the income of the parent, adjust it, and then pick up with the income of the sub, separate entity, and adjust that. So if we start now with our 3.2 million here, which is the parent's separate entity income, we need to look for two types of transactions here. We need to look at inventory transactions and dividend transactions because we know we had them during the year. We're focusing on inventory transactions first, only because we know that the parent, L, was the only seller of inventory. In other words, the sub, Bo, didn't sell any inventory to the parent. It's only the parent selling to the sub. So we know that we had two types of inventory transactions. One's from year 9 and one's from year 10. So now we had inventory transactions from year 9, so let's start there. That was when the parent L sold to Bo. We already made the point in the first part of the video when we were doing our intercompany profit schedule or our analysis. We said that any intercompany profit that was booked by a separate entity in year 9, that would be L booking it, couldn't be recognized by the consolidated entity until year 10, because that would be the year that the sub, Bo, sells it outside to a third party. At that time, the consolidated entity can book the profit. And how much profit was that? Well, we go to beginning inventory where L was selling, that's $18,000. So we're going to recognize that into consolidated profit this year. We're adjusting L's income because L was the original seller. We're also going to do a similar thing with ending inventory. L was the original seller, but we know on an after-tax basis we had $81,000 in after-tax profit that L, the parent, booked. So that's part of the 3.2 million, but the consolidated entity won't be able to recognize it until year 11 when it's sold outside. So in order to facilitate the calculation of consolidated net income, we are going to remove that 81,000. Now we also know that part of L's income for year 10 included dividends, and that was 560,000. Bo declared 800,000 in total, but 70% of it went to the parent L. So we're going to remove that because it's intercompany. This was the topic we discussed in chapter 5, in a previous chapter, right? Chapter 5. So now what we're going to do is we're going to make adjustments downward to L's separate entity income of 3.2 million. So that will give us adjusted income year 10 for L of 2,577,000. Now you'll notice we'll start with Bo's income and adjust it. But you'll notice I haven't made any adjustments. Two reasons for that. Number one, there were no inventory transactions that emanated from the sub Bo to L. They were all L, the parent, selling. So therefore there's no intercompany profit adjustments that need to be made. So we don't need to adjust Bo's income for any intercompany inventory transactions. You'll remember the land sale. That is a point where Bo, the sub, sold to the parent L. However, we don't have to adjust for profits this year in year 10. Why? Two reasons. Number one, that profit was booked separate entity in the year that Bo sold it to L, and that was back in year 8. Now, from a consolidation perspective, the consolidated entity can't recognize any of the 60,000 after-tax profit that the separate entity Bo, the sub, has booked. Why? Because L, the parent, has not sold it outside to a third party. So therefore, the consolidated entity cannot recognize it into consolidated income this year. So we make no adjustment for it. If, however, the question told us that in year 10, L, the parent, had sold that land outside, then we would be making an adjustment to Bo's separate entity income for 60,000. So we would take it in, but because we would be assuming then that the parent had sold that land outside to a third party. But because they didn't, the consolidated entity can't recognize it this year, so we just leave Beau's adjusted income equal to its separate entity income. And when we add it to the adjusted income of L, we'll get $3,977,000. That can be attributed to L's shareholders, the parent shareholders, at $2,577,000, which is the entire amount of L, the parent's adjusted income. And L's shareholders they're 100% shareholders, or they're shareholders in L. So they would recognize 100% of L's adjusted income, right? And they'd only get 70% of the sub's adjusted income because they're only 70% shareholders in the sub. So that would give us $3,557,000 in income, consolidated income attributed to L's shareholders, and the other balance $420,000, which is calculated at 30% of 1.4 million, go to the NCI shareholders, because NCI shareholders are shareholders in the sub. So they get 30% of the sub's adjusted income, which just happens to be the same as L's separate entity income, and that's $420,000. So this concludes our calculation of consolidated net income. Now what we're going to be looking for when we go into the next part of the video, part 3, is we're going to be looking at the consolidated income statement to see if we get the same consolidated income in the consolidated income statement as we did when we calculated our check figure. So stay tuned.